So we're going to begin with chapter 2 in the book, and we are going to focus on the first steps of the accounting cycle. We're going to start by kind of doing a little review of what we talked about last week. Why do we have financial accounting? It is related to numbers, although it is not math, but we communicate information to users by measuring various business activities. And when we measure them, we think about, okay, what is happening? Where are we going to put it? Is it an asset? Is it a liability? Is it part of stockholders' equity? And we come up with some information to record various transactions and ultimately present financial statements. And that's how we communicate information, by preparing these financial statements. So we are starting with measuring activities. We start by using what we call source documents to identify possible accounts affected by an external transaction. Then we take and we look at the accounting equation and we say, hey, how did this affect the accounting equation? Assets equal liabilities plus stockholders' equity. Then we're going to learn some new words today called a debit and a credit. We're then going to record these transactions in a journal. And then we're going to post these transactions to a general ledger and prepare a trial balance. So basically, we're going to find source documents. Let's start by understanding certain concepts. We put various activities or transactions into specific accounts. An account is a summary of all transactions related to a particular item over a period of time. Now, we could have asset accounts, we can have liability accounts, or we can have stockholders' equity accounts. Some examples of assets, what we call resources, can be cash, supplies, equipment, buildings, trucks. Liability accounts are generally accounts where we owe people, and they usually have the word payable after them, except one we will talk about today. But you will know it is a liability account because it will have the word payable. And then stockholders' equity accounts involve the two we've already discussed, common stock and retained earnings. And we're going to talk on more items that ultimately affect stockholders' equity today. Now, these are accounts, but each company has their own unique accounts. A manufacturing company is going to have different accounts than I'm going to have with a CPA company. A chart of accounts is a list of all account names used to record various transactions. So guys, I got to put this down 1 second. I'll be right back. So we start with looking at various transactions. And we're going to think, how do these transactions affect assets? How do they affect liabilities? And how do they affect stockholders' equity? So, if one side of the equation increases, then the other side of the equation will also have to increase. So if assets go up, then that means that either liabilities or stockholders' equity is also going to have to go up by the same amount. Or if total assets decrease, then liabilities and stockholders' equity will also have to decrease. So what we're going to do every time we start analyzing transactions, we're going to start by going, okay, let's think of one account that's being affected by this transaction. And does this account increase or does it decrease? Then what we're going to do is we're going to think of a second transaction that's being affected. And we're going to think and go, okay, does this account increase or does it decrease? After we're done looking, guys, every single time our assets have always got to equal our liabilities plus our stockholders' equity. So we're going to take our good old Eagle Golf Academies we started talking about last week, and we are going to analyze each of these transactions. And we're going to record them. We're going to pick this sucker apart, but we're going to learn from it. So we're going to take these transactions and really delve deeper. The first transaction was we sell shares of common stock for $25,000 to obtain the funds necessary to start the business. Can you guys think of one account that was affected by doing this? You can just, unmute and tell me what it is.
Common stock.
Common stock. Common stock is affected. What's another account that's affected?
Cash.
Cash. Cash is one account that's affected. Does this account increase or decrease?
Increase.
Yay, it increases by $25,000. And then we know the second account is common stock. And does that account increase or decrease?
Increase.
It has to increase by 25,000. So do you see, guys? Cash went up or increased 25,000, and common stock also increased by $25,000. Do our assets equal our liabilities plus our stockholders' equity? They do, don't they? It's sometimes tempting to decrease cash as a way of recording an investor's initial investment. But remember, from the company's perspective, the company received cash from the stockholder. That's why it's an increase in cash, isn't it? Right?
Yeah.
Now, let's look at this next transaction, guys. We borrowed $10,000 from the local bank, and we signed a note promising to repay the full amount of the debt in 3 years. Okay? What happens here?
Cash
What's
goes
one
up.
account? Cash did what?
Increase.
Increased. What else happened?
Liability.
Liabilities increase.
Liability increase.
Liability.
Yay, guys. Liabilities increased. Do we balance still?
Yep.
We do. Our assets equal 35,000. Our liabilities and our stockholders' equity combined equal 35,000. We balance. Guys, we have to balance after each time. Okay, here's another one. We purchase equipment necessary for giving golf training. $24,000 cash. What's one account that's affected?
Equipment.
Equipment and cash. Equipment increased, but cash decreased. But do we still balance?
Yes.
We still balance because both of those accounts were an asset. One asset went up, equipment, while another asset went down, called cash. But do we still have assets equal liabilities plus stockholders' equity? We do. We balance. Okay. What would be the effect on total assets if a company purchased land for 200,000 cash? Would it be A, total assets would go up by 200,000? Total assets would go down by 200,000? C, there would be zero effect on total assets?
C.
C.
Yes, excellent. There would be zero effect on total assets. Now, one goes up, one goes down, but overall assets remain the same. After each transaction, the accounting equation must always remain in balance. In other words, assets must always equal liabilities plus stockholders' equity. Always check this out, guys. Now we're going to do something new that I don't know if we talked about in chapter 1, but when the company paid 1 year of rent in advance, basically what they're doing, they are prepaying rent to last for the whole year. Any prepaid, be it prepaid rent, prepaid insurance, is considered an asset because it's a resource that will provide us with a future benefit. So Eagle paid 1 year of rent in advance, $6,000. We need $500 a month. We paid $6,000. That increases the account called prepaid rent, and it decreases cash, but we still balance. Now we have something similar. We purchased $2,300 worth of supplies. Our asset called supplies increased, but I didn't say this well enough. We didn't use cash. We purchased supplies on account, which means we have the supplies, but we owe the vendor money. We owe them. So in this case, our asset supplies increased. We didn't use cash. We owe them money. So our liability also increased. So our assets of 2,300 equal our liabilities of 2,300. And when we look at the whole picture, our assets of 37,300 equal our liabilities plus our stockholders' equity of 37,300. Okay? Now, we're going to add another little piece. Do you guys remember me telling you that last week that in our stockholders equity section, the retained earnings added the net income and it subtracted dividends? Do you remember that?
Yep.
Yeah.
Okay, remember that? Well, really,
Yep.
what is net income? Net income is really revenues minus expenses. Revenues increase retained earnings while expenses decrease retained earnings. So that the revenue and the expenses are part of the income statement. What we're going to do here, instead of just talking about assets, liabilities, what we're now going to do is we're going to take it one step further. And when we start having transactions, we know that revenues increase retained earnings, expenses decrease retained earnings, and we know dividends also decrease retained earnings. So we know our revenues and expenses make up our net income. And we ultimately take our income statement and put our net income and retained earnings. But for the time being, we're going to take these transactions and see how they play out in our accounting equation. What happens when we provide golf training to customers for cash of $4,300? What's an account that increases?
Cash.
Cash increases. What
Account receivable.
else is increasing? Our revenue's increasing, isn't it?
Yep.
Because we are providing a service. When we perform this service, we receive revenue. Revenue increases, and we know revenue adds to retained earnings. But guys, do we still balance?
Yes.
Our assets of 41,600 still equal our liabilities plus our stockholders' equity. What happens when we provide golf training to customers on account for 2,000?
Accounts receivable increases.
Yes. And our service revenue also increases, doesn't it? Do we balance still?
Yes.
We're still balancing after every transaction. Now, remember me telling you that you will know it's a liability because it always has the word payable after it, except one account? This is the one account. This account is a new name to learn, and it's called deferred revenues. Deferred revenues is when we owe somebody something. A liability is when we owe somebody something. But in this case, listen to what happens. We receive cash in advance for 12 golf training sessions to be given in the future. So we receive $600. Our cash increased $600. But guys, this isn't revenue because we didn't earn it yet. We got the money without doing the revenue, providing the service. This is when we have what we call deferred revenue. We owe a customer something. We owe them some golf lessons, don't we? That is why it's a liability. Our assets, though, still equal our liabilities plus our stockholders' equity. Okay, guys, what will happen after we perform this service is then we will no longer have that liability. So the liability will go down, but our revenue increases. Okay? Don't let the account name fool you. Even though the term revenue appears in the account title for deferred revenue, this is not a revenue account. Deferred indicates that the company has yet to provide services, even though it has collected the customer's cash. The company owes the customer a service, which creates the liability.
Can I ask a question?
Of course.
So after the service is provided, it would then move into the stockholders' equity, making it still balanced?
Yes.
Okay.
It would, the liability would decrease, the stockholders' equity would increase, but we would still balance on that side.
Okay, thank you. Yep.
Bet. Now we pay salaries to employees. We paid salaries of $2,800 to employees. What happens to our cash? It decreases $2,800. What happens to our retained earnings? It also decreases $2,800 because expenses decrease our retained earnings, revenues increase our retained earnings. Do we balance still? Heck yes. Next, we pay cash dividends of $200 to shareholders. We use $200 in cash so that cash decreases, and dividends decrease our retained earnings, which is part of stockholders' equity. So our $41,200 assets equal our liabilities plus stockholders' equity of $41,200. After we've gone through all of those transactions, do you see we have our assets, which is a category, which we call resources. And in those assets, we have several accounts. We have an account called cash. We have an account called accounts receivable. We have an account called supplies. We have an account called prepaid rent. And we have an account called equipment. These are individual accounts all under the big umbrella assets. They all total $41,200. They equal our liabilities, which is an umbrella category, plus stockholders' equity, which is also a category. We have 3 accounts under our liabilities: accounts payable, deferred revenue, and notes payable. Then our stockholders' equity, we know, have 2 accounts: common stock and retained earnings, or I should say 2 categories under our stockholders' equity. And we did increase or issue some common stock, but all the others, retained earnings, our revenue increases our retained earnings, our expenses decrease our retained earnings, and our dividends also decrease our retained earnings. But guys, do you see that our assets of $41,200 still equal our liabilities plus stockholders' equity of $41,200? So what effect does the payment of dividends have on the accounting equation? Do assets decrease and equity increases? Do assets decrease and equity decreases? Do assets decrease and liabilities increase? Or do assets increase and equity increases? Guys, just think it out. What account goes up? What account goes down? Or what's going on here? Yes,
B.
B is right. Our assets decrease when we pay cash, it decreases. And our equity, our shareholders' equity under retained earnings decreases because we are giving back to the shareholders some of the net income, the earnings of the company. Okay.
I have a question.
Yes, you raised your hand. How can I help you?
So the equities is the issue stocks, right?
Stockholders' equity contains two sections. Stockholders' equity contains common stock here plus retained earnings. The common stock is the capital or the equity raised outside of the company when people choose to invest in the company. Retained earnings is the equity or the net income, the earnings of the company that stay in the company. So revenues increase our retained earnings. Expenses that you need in order to have a company to make revenues decrease our retained earnings, and dividends also decrease our retained earnings because we're giving that back to the shareholders. So common stock along with the retained earnings make up our stockholders' equity section. Does that answer your question?
Yeah, it does. Thank you.
You bet. Now, guys, this is important. I wish we could be in person to show you this, but here's the deal. We're going to talk about the words debits and credits. Basically, I want you to know all the word debit means is left. All the word credit means is right. Do you see on this asset, the left side of this account, this T account we call it, says debit. The right side says credit. Debit just means left. Credit just means right. Do you see over here? Debit is on the left side. Credit is on the right side. Over here, stockholders' equity. Debit is on the left side. Credit is on the right. Debit just means left. Credit just means right. Period. Now, assets are on the whole left side of this equal sign, right? Liabilities and stockholders' equity are on the right side of this equal sign. Remember, though, debits mean left, credits mean right. But assets, that category assets such as cash, accounts receivable, supplies, prepaid insurance, to increase an asset, we debit it. All that means is we put it on the left-hand side. Period. Liabilities and stockholders' equity are on the right side of this equal sign. To increase a liability or to increase stockholders' equity, we credit it since it's on the right-hand side. So guys, this is important for you to have written down when you do homework, when you do quizzes, when you do anything. This accounting equation that shows assets equal liabilities plus stockholders' equity. Assets you debit, put on debit on the left-hand side to increase. Assets you credit to decrease. But for liabilities and stockholders' equity, since they are on the right side of the equation, to increase a liability or a stockholder's equity, you credit it. To decrease a liability or a stockholder's equity, you debit it. This is so crucial that you know a debit doesn't mean add or a credit doesn't mean subtract. It's true for assets, but it's not true for liabilities and stockholders' equity. So a lot of you might be thinking, bull, I go to the bank and when I give them money, they say, we credited your account. Don't they say that?
Yep.
Guess why? They say they credited your account. What is your account in the bank's books? It's a liability. Think about it. From the bank, you go and you give them $1,000. What does the bank do? The bank debits cash, credits Katie's bank account. Liability. Is it their money? No. They owe you $1,000, don't they? Do you see
Yes.
why now they say they credit your account? To them, it's a liability. Your account is a liability. They owe you that money. That's why they're telling you they credited your account. Does that make sense, guys?
Yep.
So
Yes. I just wanted to say I really appreciate this clarification because in my brain, like it was not, I was not able to make these connections. So
Of
thank you.
course not. Why would you? Because your whole life you've heard a bank credits your account. That must mean increase. Well, it is an increase to your bank account, but to them, it's a liability. Okay. Remember, debit means left, credit means right. To debit an asset means it's going to increase. But guys, to debit a liability or a stockholder's equity account, that's going to decrease it. For credit, which is on the right-hand side, to credit an asset means to decrease it. But for liabilities and for stockholders' equity, a credit is an increase. That is why I want you to take this screen, get a piece of paper, and write this out. So when we talk, we're going to start doing other things. You can look at that and go, oh, that's right. That a liability, a debit decreases. Oh, that's right. A debit for an asset increases. This visual is so important to have. Okay.
There's a really good page in the book too, page 72, that lists even more than that.
Yes, it's awesome. Guys, take that page and print it. Remember, you can have, it's not a cheat sheet because that sounds like it's bad. You have notes. That's how we learn. So know this. Since assets are on the left side of the accounting equation, we debit those assets to increase. Since liabilities and stockholders' equity are on the right side of the accounting equation, we credit those assets to increase. Now you see this one. This just expands it even more. Revenues increase retained earnings. So that it's going to follow the same guideline. When you add increase a revenue, you're going to credit it. When you decrease a revenue, you're going to debit it. But expenses and dividends are going to work the opposite. And think about this. An expense ultimately decreases retained earnings. That's why we debit expenses and we debit dividends. The account expense and the account dividends have a normal debit balance. This is another slide you have to write down and keep beside you. Dealer, DEA, those accounts stay, or those categories stay on the left-hand side of the equation, meaning to increase dividends, to increase expenses, or to increase assets, you debit them. LOR, liabilities, owner's equity, are stockholders' equity and revenue. To increase liabilities, owner's equity, and revenue, we credit them. Okay? This is such a good way to learn it. Someone's texting me, so I'm trying to see what's going on. I'm glad I'm not alone. I was getting a little frustrated with it. Me too. Thank you for the clarification. That really threw me for a loop. I'm not sure about anyone else. Hey guys, you know yourself. You're not dummies. So if you're having troubles with something, don't you think everyone else is too? And guys, remember too, I get paid so you can be successful, so you can learn. So I don't care what I have to do to help you learn. This is my job. You're not here to make me feel good. I'm here to help you learn. So never, ever be scared to ask any question. And if I ever come across as though it bugs me, call me out on it, because that's not my job. My job is here to serve you guys. You got to do your part too. You know, I say that to you all the time, but my job is to help you get this stuff. So if we don't get any farther just sitting here learning this, this is crucial. Got it? Know that. Oh, guys, if you get this wrong, I think I could reach into this computer and slap you. What does the word debit mean?
Left side.
Are you sure?
Yep.
Yes, left. What does the word, oh, well, you know, the word credit means right. Okay. Now, you know I'm joking when I say I could slap you. You get that. Okay. Now we're going to talk about recording these transactions using debits and credits. We're going to record transactions in something called a journal. And we are going to provide journal entries into this journal. This journal entry is just the format we nerds, accountants use to record or communicate these transactions. We always show the account that is going to be debited first. Always. We always then show the account or accounts that will be credited next. This is the format we will always use. And guess what? Each of these debits must equal credits. So let's look at our transactions again, guys. On December 1st, Eagle Golf Academy sells shares of common stock to investors for cash of $25,000. What are we going to do? We're going to debit cash 25,000. We're going to debit common stock 25,000. Now let's just think about this, guys. Why did we debit cash 25,000?
Because we're adding.
Because it's increasing, right? And cash is an asset. To increase an asset, we debit. I know I'm sounding redundant, but I'm trying to help you think it through. Instead of just in your head going, oh, I got to debit it. But why? Cash is an asset. And assets on the left side of the equation. Left equals debit. We increase cash, that means we debit it. Common stock is on the right-hand side of the equation under stockholders' equity. When we increase common stock, we credit it because it's on the right-hand side. Many students forget to indent the credit account names. For the account credited, make sure you indent both the account name and the amount. You see how I did it here? The account name is indented and this credit side is over here. Got it? Yep. Okay.
Yep.
Now, what we're going to do is we create a journal entry. And every transaction we create, what accounts are affected? Do we debit them or do we credit them? When we're done doing all those, we are then going to post each one of these accounts or these transactions to the various accounts. So as you see here, we are going to take cash of 25,000 and we are going to find the account that is cash. And we're going to put that 25,000 here on the debit side. Also, we're going to take the account called common stock. And we're going to post this transaction right here, common stock, credit 25,000, December 1st, issue common stock, credit 25,000. We're going to post this portion of this journal entry down here to the account common stock. Now, guys, in the real world, software does this. But if you can believe how old I am, my first job out of college was working at a mortgage company. And I had to do all this by hand. They didn't have computers back then. They just started getting big mainframes. So fortunately, I had an Apple where I could at least use Excel and not have to add everything always on my own. But I would have a big green account register book where I'd have to go and plug these numbers in every day and balance them. Now, thank God we have computers that do it, but you still need to understand the flow of what's going on. Now, the transaction on December 1st, Eagle borrows cash from a bank for 10,000. What happens? Cash increases, notes payable increases. Cash is an asset, we debit it. Notes payable is a liability, we credit it. Do you see when we post it? We're going to debit this. So now we have 35,000 in cash, don't we? Okay. Next, On December 1st, Eagle purchases equipment with cash of $24,000. So what happens? Equipment increases, cash decreases. All we're doing here, instead of showing it into an account form, we're now just kind of using what we call a T account, which is kind of an easier way of looking at the general ledger. Do you see equipment? The balance now is 24,000 debit. By crediting that cash, do you see how our cash balance is now 11,000?
Yeah.
Tell me if I'm going too fast for you. On December 1st, Eagle pays 1 year of rent in advance of $6,000. We see the account prepaid rent debited, cash got credited. Because cash was being decreased, we credited it. Prepaid rent was being increased, therefore we debited it. On December 6th, Eagle purchases supplies on account for $2,300. Our supplies increased. Our accounts payable also increased. But accounts payable is a liability. So that makes sense that we credited it, because for liabilities and for stockholders' equity to increase, we credit them, right?
Yes. And I have a question. So, you know the T charts?
Yes.
So,
T
like,
accounts?
the T accounts, yeah. So you know how assets and liabilities or equities have to equal the same, right?
Yes.
So if there's like two liabilities, then the amount balance at the end could be different.
Correct. Everything can be different, but at the end of the time, the total assets must equal total liabilities plus total stockholders' equity. So
But the other,
in the end, everything on the left side must equal everything on the right-hand side.
what about the previous examples? Like the balance didn't match up.
What do you mean?
Like this one.
Well, they're both cash. So, or excuse me, both assets. So when
Oh,
we are showing that we bought the transaction, in this transaction, the debits need to equal the credits. That's what each transaction is focusing on. So once this transaction gets posted, it does balance, because the overall assets equal the liabilities plus the stockholders' equity. Because what happened here, one asset went up, one asset went down, but we still equal.
okay.
This is just showing you the balances, but it's really not taking into account the entire assets equals liabilities plus stockholders' equity.
Okay. Yep.
I think there's a good example of that in the assignment, actually, once we get to that point.
Correct. And you're going to see it coming up in this PowerPoint too. So then when we show supplies and accounts payable, supplies increased, we debited it. Accounts payable increased, we credited it. When on December 12th, Eagle provides golf training to customers for cash of $4,300. Cash increased $4,300, we debited it. Service revenue increased 4,300. We credited it. On December 17th, Eagle provides golf training for customers on account. Cash increase, no, on account, sorry, not cash. Accounts receivable, which is an asset, increased by 2,000. We debited it. Service revenue, which is a revenue account, ultimately affecting stockholders' equity, it increased 2,000. We credited it. But this particular transaction, the assets equal, or the debits equal the credits. On December 28th, Eagle pays salaries to employees for 2,800. Salaries expense increases by debiting it. And think about this, it's also reducing our stockholders' equity. That's why we debit it too. To decrease cash, we credit it. It's reducing our asset. But do our debits equal our credits? Yes, they do. On December 28th, Eagle pays cash dividends to shareholders of 2,200. What are we doing here? Dividends increase, and we know dividends have a normal debit balance. We also know something about dividends, that they ultimately decrease our stockholders' equity. And to decrease stockholders' equity, we debit it. So that makes sense. Cash is decreasing. When we decrease an asset, we credit it, don't we? So we have gone through every transaction. We've put it in a journal entry format. And then we posted all of these journal entries to the various accounts here. Each account falls under a category. Our assets here are cash, accounts receivable, supplies, prepaid rent, and equipment. Our liabilities are accounts payable. That weird payable is the only one that doesn't have the word payable after it, called deferred revenue. And notes payable, those all have credit balances to increase them. And our stockholders' equity have credit balances to increase, debit balances to decrease. Our service revenue increases retained earnings ultimately. And our salaries, expense, and dividends reduce retained earnings, which is why those are being debited. If we took all these balances, 6,900, 2,000, 6,000, 2,300, and 24,000, and we took all these balances, guess what? Our assets, 89, 32,9, 38,9, 41,200 are assets. They will equal the liabilities plus the stockholders' equity. These assets will equal the combination of liabilities and stockholders' equity. Which of the following is used to provide a chronological record of all transactions affecting the firm?
B.
The journal. And which of the following accounts would be debited when a company pays $12,000 in advance for 1 year of rent?
C.
What is it?
C.
C. So what we're going to do is, as we go through what we're doing, we're analyzing the transactions. We're going to record them in a ledger through the form of a journal entry. Then we post them to the various accounts. Now all we're going to do is put them in a sheet called a trial balance, where the list of all accounts and their balances at a particular date. So all the debits, accounts with debits, will equal all the credits. You see here that our debits of 44.2 equal our credits of 44.2. This just is an easy way for us to ensure we're on track. Now, the computer's going to make us on track, but we are on track in this form. They have to equal. Which of the following accounts would appear in the credit column of a trial balance? Any ideas?
Would it be C?
C, exactly. So guys, what I'm going to do now, I know I told you I was going to turn off when we do homework, but I'm going to do some homework first. I feel like, oopsie, oh, Caitlin, I'm so sorry I did that. Didn't mean to. We are going to do some homework. Because I want, now, I'm going to just do one problem and then I'll turn off the recording and we'll do some more. But I want you to grasp how this is working. So here's Jayhawk Corporation. Below is a list of activities. We need to determine what happens with this activity. So is anyone brave enough? I don't want to call on you and freak you out, but is anyone brave enough to take number 2?
I'll do it.
Thank you.
Yep. So it would be an
Say
increase for
purchases business supplies on account. We're just going to say
purchase business supplies on account would be an increase of assets, an increase of liabilities, and no effect on stockholders' equity.
How many of you agree?
I agree.
It's right.
Yep.
Why? Supplies are an asset. They're increasing. When we purchase them on account, that means we owe them money. That's a liability. It increases. Nothing was affected with stockholders' equity. Now, let's take number 3.
Would you like me to do that one as well?
Sure.
All right. Pay for legal services for the current month. It would be a decrease in assets, no effect on liabilities, and a decrease in stockholders' equity.
You are exactly correct, but I'm going to bug you a little more. Why
Okay.
is it a decrease in stockholders' equity?
Because it's a dividend, you're paying something out.
It's actually not a dividend, it's an expense. But an expense reduces retained earnings. You're exactly right. So a decrease, no effect, and a decrease. Perfect. Let's look at repay loan from the bank. We borrowed money, but now we are paying back the bank. We owe them something. We are paying them money. What do we pay them with?
Cash.
Asset.
Cash. Yes. I mean, I should be careful. What should we be paying them with? Cash. What happens to cash?
Decrease.
Decreases.
Increases. What happens to liabilities?
Decrease.
Decrease.
Decreases. We're not going to owe them that anymore, are we?
Yeah.
Okay. Let's look at number 10. We receive cash from customers in 4 above. In 4 above, we provided services to customers on account, which means we didn't get the cash yet, they owe us. Okay. So up here, we increased an asset called accounts receivable. Okay. And we also increased our stockholders' equity. What happens when we got that cash from that customer?
It increased cash.
No effect.
Increased cash, but what else happened?
It increased stockholders' equity.
It decreased accounts receivable.
Correct. It increased cash. It decreased accounts receivable. Both of those are assets, aren't they?
Yep.
Yes.
So ultimately, with assets, there was no effect, was there?
Mm-mm.
Right?
Yes.
You can always check your work. The answer's not complete, but you can check your work, okay? This is the same concept. Instead of showing increase or decrease, we're actually using numbers. I'm going to give you a hint. Who was that? Was that Leo earlier?
Yep, I think so.
Hey, Leo, dude.
Yep.
I want you to try. Now, Leo, can I tell you I'm picking on you because it seems like you have a little bit of knowledge, okay?
Okay.
Okay, let's look at number 3. Hire a new employee. And I'm going to tell you this is a trick. It's not a trick. It takes a little more thinking.
I
Hire
remember
a new
that's one of those
employee
readings.
who will be paid $500 at the end of each month. What's going to happen here?
So we're hiring a new employee. We're not paying him yet because we're paying him at the end of the month. So I would say we increase,
Does anything happen?
no, because we haven't
Yes, that's correct.
paid him yet.
Guys, no, sometimes there was not an economic event. This was just a statement. Okay?
Mhm.
So guys, nothing happened. Yeah, we hired an employee, but is this a financial transaction?
No.
No. I want you to be aware of that. In this scenario, it would be nothing. Now, you have to put in zeros. I think you might have to put in zeros.
Yes, you do.
Okay? Another
Could
thing
you
I
go
want
over
to show you
number
that's
4
tricky.
on this as well? Because I actually got caught up on that one.
Do you see purchase office supplies for 400 cash?
Yes.
Okay? What increases?
Assets
Asset increase.
or well,
Asset
supplies,
increases 400. What decreases?
Cash
cash.
decreases.
Which is an asset, right?
Yep.
Yep.
See how I did that? Because they're both assets, you see how they gave you 2 columns or 2 rows?
Yeah.
I'm sharing this with you so you know how to handle this and you know how to handle number 6. When they give you 2 rows, it's for a reason. Okay? Does that make sense?
Yep.
One asset increased, another one decreased. Okay? This is important. This is the account. You tell me, is this account an asset, a dividend, an expense, or a liability?
Liability.
In this way, yes. And is the normal balance a debit or a credit?
Credit.
Credit.
Guys, do you see your little notes are going to help you here?
Yes.
Yep.
Right? Let's talk about utilities expense. Katie, will you take this one?
Yep. Utilities expense would, the type of account would be an expense and it would be a debit.
Correct. Now, I told you a secret about expense accounts. There's one word they always have. What is it?
Expense.
Expense.
Expense. There's one word payables always have except for deferred revenue payable, and that is,
Payable.
you get it, okay? Okay, I am going to end the lecture now, but we're going to continue on. Are there any questions before I end this lecture, guys? The recording?
I don't think so.